Hello everybody, Bill Mervin with AnnieMac Home Mortgage here in Newtown, Pennsylvania. For today's blog, we're going to be discussing refinancing your existing mortgage and finding out if it could make sense for you. Before we begin, I want to draw your attention to a link on our blog. Just click on that link, fill out your information, and myself or someone on the team will get back to you right away. So today's topic is refinancing your existing mortgage. There's been a significant uptick in refinance activity over the last 30 to 60 days, and it's due to a number of factors. The first factor is interest rates have fallen again. They're sitting very, very close to their all-time lows here in the United States. The second factor is home price appreciation. The last few years have seen some very good years, especially locally, in the increase in home values in the area. Why that matters to a potential refinancer is that many people have purchased their home with FHA mortgages, or they didn't put 20% down. So if you have an FHA mortgage or you didn't put 20% down, you likely have mortgage insurance. That's that pesky extra amount of money every month that's on your statement that doesn't do any purpose for you. It just serves to protect the bank because you didn't have enough equity in the property at the time of your purchasing. So if you were to do a refinance now, even if the interest rate doesn't decline all that much, maybe even a quarter point, most people for a quarter point in savings, quarter percent in savings, wouldn't consider a refinance. But if you're also able to knock out a half a point or 1% a year in mortgage insurance, which is fairly customary, there's going to be enough savings to justify the loan. So if you put 10% down and now you are 3 years into the mortgage and now the home prices in your area have increased, there's a very good chance that we can do a refinance, lower your interest rate, and also get rid of the mortgage insurance. Additionally there could be multiple other reasons to do a refinance. So you could do a rate reduction, and you could keep your term the same. You could keep a 30-year mortgage. That might be a good idea if you have other expenses. So you might have credit card debt, or you might have something coming up like a child going into college. And then you can always go. This is what most people miss out on. Just because you get a 30-year mortgage, some people say, Bill, I don't want to go from 27 back to 30 years. But you could do that temporarily, use those savings to knock out that credit card debt, or use it to fund that college education, and then at the period that the debt's paid off or the college is done, you can then apply that additional money that you're now saving, and you can actually reduce the mortgage down to 20 years or 25 years. So just because you free up some money in the short term doesn't mean that you have to keep paying the mortgage over that same period of time, and you can always apply extra and pay it off quicker. Another really good opportunity right now is term reduction, which is taking your mortgage, lowering the interest rate, and then using that interest rate savings to pay your mortgage off quicker. I just did a 20-year mortgage for somebody. They went from 27 years to 20 years. It only increased their payment $50 a month, and they're going to save about $150,000 of interest. So in short, there's a lot of different opportunities for people in all sorts of different situations to potentially use a refinance to save some money or to meet some other financial goal. The only way you're going to find out is by reaching out to myself or someone on the team, giving us a little bit of information about your situation, and let us put some ideas together to see if we can help.